Hey guys, what's going on? It's 2020 and we're trying to get into some more investments here. What are your thoughts? Are we going REITs or are we going physical real estate? Stay tuned and let's find out. Welcome back everyone, I am Brian, the Real Bearded Businessman. Great to see you guys again in 2020. And one of the things I wanted to talk about today is how are we going to attack 2020 and attack our investments? So one of the things that if you guys have seen some of my other videos, you'll see that I'm a big investor in stocks and in the market. And one of the things I've always kind of been curious about is trying to get more into physical real estate, whether it's buying and selling, or whether it's even just buying and holding property and possibly renting it out. So I've been doing a lot of research on that, and I actually came across the news article the other day, and I kind of thought I wanted to share at least a breakdown with you and kind of see what your opinions are. I guess I'm really looking for some help. Maybe if you guys out there are physical real estate investors yourself, I want to make sure that I'm kind of not rounding over the corners too much and actually really thinking this through. If you guys invest in physical real estate, let me know down in the comments below. I'd love to talk to you about it. So let's get into it, right? So it's 2020, the stock market's doing really well. The housing market's doing really well. If you're trying to sell a house, it's absolutely a seller's market in most places, right? So that's, everybody's talking about, investing and stuff like that. So my issue has always been is trying to find an easy way to compare, say, investing in REITs or investing in REIT ETFs, and try and compare that accurately to what investing in physical real estate would be. And I'll tell you right now, I find it very difficult. I don't know what you guys are thinking out there, but I think it's pretty tough because I don't really see a whole lot of apples to apples comparisons. I see a lot of, well, you do this with REITs but here's your pitfalls with physical real estate or vice versa. And when you start digging into those people that are giving you that type of advice and guidance, you start finding out, well, the people that like the physical real estate investing are physical real estate investors, and REIT investors love REITs. Looking through this article here, one of the great things was they actually tried to do an apples to apples comparison, and it seemed like it was pretty tough, but they had to make a lot of assumptions. And what I wanted to kind of do today is just kind of go through and make a couple of assumptions of my own and kind of walk through this with you. And if you do see any spots where, hey, I'm making too many assumptions or I'm not making enough assumptions, I want to hear all about them. One of the things I wanted to bring up, right? So when investing in real estate, you have to have some sort of down payment. It's most likely not going to be your primary residence, so you're going to have to bring in a pretty significant nest egg or a pretty significant down payment, right? So you're probably at a minimum going to have that 20%. But in all reality, it's probably even safer for you from a risk standpoint if you bring in the full down payment, right? So I'm assuming here that I have a $60,000 initial investment. The reason that I say that is I'm assuming that I have $60,000 in the bank right now, ready to go, and I'm standing in front of a house getting ready to invest. So let's say the house costs 60 grand. I'm assuming that I'm not paying any mortgage and I just hand a 60 grand and that covers everything, right? But we all know it probably doesn't, depending on your area. You're probably gonna have to spend a little bit more. So you might have a mortgage or some other loan to help you either buy or help you fix this place up, right? So I'm assuming that I don't need any of that, right? So that's the safest way on a physical property. But the other thing I'm gonna come up with is I'm also gonna start that same 60 grand in a stock market investment or a REIT, right? So I picked one of the REITs that I currently own. And right now, as far as a dividend is concerned, it's dripping me about 7.5% annually. So I love the performance of it. The price from I guess the beginning of 2019 to the end of 2019 hasn't really differed. I mean, it's had its ups and downs, but it's pretty steady. I mean, I gotta be honest, I haven't made a ton of money just on the investment itself from the interest that the shares have grown. So But yeah, so we're starting with 60 grand on both sides. And I'm assuming that I'm getting the dividend, the 7.5% annually. And I'm also assuming that the stock price isn't going to increase, and that it's going to stay relatively flat. If I buy it for $50 a share today, I'm assuming that 2 years from now, it's still going to be 50 or maybe 55, right? So I'm trying to keep things as level as I can. So the first thing is I'm looking at it from a risk standpoint personally, because I'm all about risk, and I'm also trying to find what's best for me. So let's start with that 60 grand. I go buy that house, I put it down, I get it all ready to go. No money out of my pocket aside from that 60 grand. Now it's time to rent, right? So depending on your area, I've been doing some research, and it seems like, I mean, every once in a while you're gonna see those areas where you're making $2,000, $2,500 a month. But I think that from what I've seen, at least in my area, majority of people are, by the time they make all the mortgage payments and the tax payments and stuff like that, and they're paying the property management folks and whatever they have to do, it seems like they're bringing in their monthly income is about $500 to $1,000 a month, right? So, and I think that's a pretty fair conservative estimate. You're buying a house. It's not going to be a mansion where you're going to be able to charge exorbitant amounts of rent, but it's about where it needs to be. So I'm trying to figure out now, so if you got $500 a month coming in, well, what are some of the other risk areas? And for me, I'm always worried about what's the real estate market going to do, right? So that could drop like a rock, and I'm still stuck with a property that is now of lesser value, right? So I'm still making mortgage payments on it, and I hope like hell that that my renter still stays, right? So that's a problem. The second one is like, well, hopefully that renter takes really good care of my property, and I don't have any sort of issues to fix and leaky pipes to fix, and they haven't put holes in the walls and stuff like that. And to me, that's a big question mark, and that's probably the one that scares me the most and kind of pushes me away from real estate investing personally. So yeah, so those are kind of the items that really, to me, are risky with physical real estate, right? So that's why I think, also let's compare it to REITs, right? So you have the risk that's associated with physical real estate, but investing in REITs, you're absolutely at a, you are absolutely a victim of the stock market. Today it's 29,000 and change, right? The Dow Jones, that is. But tomorrow it could drop like a rock. And then within the next week to 2 weeks, it could really go down. And now you're stuck with, you bought these shares high, and now you're selling them way lower than when you bought them. So those are kind of the risk areas, and those are kind of the pieces that scare me, right? So again, my assumption is you're going 60 grand in, and you're going to be pulling real estate, you're going to be pulling $500 a month off. That's what my assumption is here, right? So let's go through some calculations here, right? So I put in that I was making a $60,000 initial investment, and I was dripping 7.5%, which I know for a fact I currently am with the REIT that I have, so it's not that crazy. So at the end of the first year, if I contribute $0 more than that 60 grand, again, keeping it 100% equal to the house, at the end of that month, or at the end of that year, I'll be dripping $4,500 a year. That's crazy. That's a lot more money than I thought it was going to be honest with you. Again, we're assuming that we're not making a dime more on any of these share prices, right? So no increase there. I'm just working off of dividends that drip. $4,500 a year, comes out to $375 a month for that first year, right? But if you've been watching any of my videos, you know that I drip and I reinvest those dividends back in, right? So second year, that $4,500 turns into $4,850. So now I'm bringing in $405 a month. So that's an increase of about $30 a month. So I continued doing these calculations because I figured if you get a mortgage, you're probably, the earliest that you're going to really be able to pay it off is probably 10 years. And I know that in the assumption that we're not getting a mortgage, so I get that. But what I really wanted to do is sit down and say, all right, so 10 years, what are we really at? And I use 10 years as a benchmark. So if we fast forward to that, so after 10 years, we're dripping $86.60 a year is what that drip is. And that comes in as a monthly income of $721. So what I think is that's pretty interesting stuff. The fact of, if you do nothing over 10 years, you're bringing in literally $720 a month, no matter what, provided that they never lower that dividend, right? So why is that interesting to me? And I think, to me, it's very interesting because, at least for me, I'm all about risk and minimizing my personal risk, right? So items like, I don't want to have a mortgage. Well, if I save up 60 grand and invest 60 grand, it's right there. It's good to go. No, there's no more money coming out of my pocket, right? The second piece to it is what happens with market volatility, right? Well, with the house, I'm at the mercy of not only the market, but of the renter and their economy as well, right? If they all of a sudden can't afford to pay me rent, now I gotta go through possibly lawyers, all kinds of other stuff. And by the time that all happens, they're not gonna be very happy with me. Likelihood of them going and doing something that I'm going to have to repair in that house, it starts going up over time, let's be honest. So that's kind of the other thing. But with the REITs, yeah, you still have the market volatility, but oh, by the way, at the end, if this thing starts tanking and Dow goes from 29,000 and change today to, I don't know, in a couple days it goes down to 22, right? I'm just making that number up, but it goes down to 22,000. I can sell that immediately. I'm locking in some losses, but I can stop the bleeding, so to speak, a lot faster than it takes to sell a house. To me, that is a huge value, at least, is the fact that, hey, I'm losing, but I'm not losing as much as fast, and I have way more control over that. So that's all I have for today. I really appreciate you guys sticking around, walking through this with me here, doing some calculations. Like I said, this is actually more of a question for you guys that actually do physical real estate investing. What do you think? Do you like it? Do you not like it? And what are some of the pitfalls that you found? Let me know below. I'd love to talk to you. And again, maybe I'm making too many assumptions here and I'm actually still losing out by investing in REITs. Let me know what you think, guys, and we'll go from there. So I hope you guys are having a great 2020. Full of success. I wish nothing but the best for you, and I'll catch you guys on the next video.